We're diving into the topic of calculating bad debts, a critical component in managing financial risk. Understanding bad debts is essential for businesses to maintain accurate financial statements and ensure long-term sustainability. So, let's get started. Bad debts arise when a company is unable to collect the money owed by its customers. To account for this, businesses use two primary methods: the direct write-off method and the allowance method. Each has its own application and implications. The direct write-off method is simple and straightforward. In this approach, a business recognizes a bad debt expense only when it's determined that a specific account is uncollectible. This method impacts the income statement directly, since the bad debt expense is recorded as soon as the loss is confirmed. While it's simple, this method may not comply with the matching principle under GAAP, as it doesn't account for losses in the same period as the related revenue. On the other hand, the allowance method provides a more systematic approach by estimating bad debts at the end of each accounting period. Here, companies set up an allowance for doubtful accounts, which forecasts potential losses based on historical data and market analysis. Two commonly used techniques within this method are the percentage of sales and the aging of accounts receivable. The percentage of sales approach estimates bad debts as a percentage of total sales based on past experiences. By applying this percentage to the current period's sales, the company sets aside an allowance for expected losses. This method is straightforward, but assumes a consistent pattern of bad debts over time. The aging of accounts receivable method sorts customer accounts by age and applies different probability rates of default to each category. Older receivables are more likely to turn into bad debts. This provides a more detailed analysis and aligns well with actual collection risks. Choosing the right method depends on various factors, like company size, industry, and regulatory requirements. Understanding these methods not only aids in creating accurate financial statements, but also enhances decision-making and strategic planning.